So a disadvantage to owning ETF versus like a mutual fund? I'd say the biggest disadvantage is, and I'll compare it to an actively traded mutual fund versus a passive an index fund, where an index fund and an ETF are kind of the same. You just get some special qualities in an ETF in terms of trading like a stock. The biggest difference is with an ETF, you're at the mercy of whatever those stocks do. That basket of stocks, there's nobody overseeing it really. They're not making decisions on what stock to get in and out of. They're not maybe going to cash to prevent the whole portfolio from going down if the market were to correct. We're at a very interesting point in the stock market where we're at all-time highs. Now, I don't know if we're at the end of the all-time highs or if we're somewhere in the middle of the game. But, when that market starts to turn, which inevitably it will, it does, it always has. We've had 32 bear markets since 1990. So about 70% of the time the market goes up, but we do have times where the market goes down. And so the disadvantage of owning the ETF is you're going to go down with it. Whereas an active mutual fund may be able to help protect some of those dollars that you have invested. Now, if you're looking at over the next 30 years of investing, you want it to go down. And we can explain that a little bit more later, and we can get into that in the retirement workshop in 2 weeks. But as you're putting money in, you actually want it to go down. Now, folks getting ready to retire, like my folks, they're getting into retirement. They don't want it to go down. They want it to go up. I want it to go down because I'm still putting money in, and I want to buy cheap. And so that would be the biggest difference, is you're not going to have somebody actively looking over it, but you can. And if you're working with an advisor and working with somebody that's helping you, they can help you make those decisions as well. And it may be that you just want to ride it out and continue to put more money in. Okay?
I have a question.
Yes.
So even though the underlying mutual fund, which ETF we are buying it, is performing bad, the price of the ETF can go up.
If the ETF, the underlying stocks are performing poorly?
The underlying mutual fund is performing bad. Will the price of ETF reflect that, or there is some inefficiency in that?
So the mutual fund is a separate investment vehicle, and then the ETF is also another type of investment vehicle. So the ETF, if the basket of stocks that it owns is performing poorly, then that ETF's price will go down.
Is it like there is no efficiency in that? That even though people want to pay higher, the underlying portfolio of that ETF is performing poorly?
It could. You mean if people are putting money in because it's going down, will it drive the prices back up?
Yeah.
It not necessarily. I mean, the overall market, if there's a huge demand for those stocks in particular, then the prices of the ETF are going to go up because of the demand of those companies. You may see it if it's a big enough ETF. You may see if enough money's going into it. You may see some of those stocks go up. But typically, if the market's going down or we get into a bear market cycle, everything's going to be going down with it. Now, you may see some small cap names do well. Maybe some other types of stocks do well. Maybe some energy sector stocks. Certain things might start to perform on their own. But if we get into a bear market and you own an exchange traded fund of, let's say, tech stocks, and the tech industry is getting hit, you're going to go down with it. It's going to take a lot to get it reversed back. Yeah.
Do any mutual funds or ETFs give dividends?
They do. So they do. So a lot of them will pay dividends and then also capital gains. And so a capital gain will come from a mutual fund of the trades that they make throughout the year on your behalf. If there's a gain from all of that activity, they're going to pay it to you at the end of the year. And you're going to have to pay taxes on it, whether you like it or not. Okay? And that's where the ETFs are more tax efficient, because you control the gain, because it trades more like a stock and they're not trading inside of it. Whereas an actively managed mutual fund will create taxes, but they're also going to generate dividends from the stocks that they own. So they'll take all the dividends and then it'll be an average number, and then they'll pay that out based on the portfolio.